All right, guys. Thank you for attending today as we embark on our second training for the year. So again, every Thursday, 4 o'clock Central, we will be doing these trainings unless I unfortunately have to cancel like I had to last night, but I was out and about in Memphis. But today is really important as we always talk about not only just knowing the products, but more importantly, how do you illustrate them? What's the understanding and how to actually take the theory and the concept of what you're talking about, put it on paper so you have a better understanding on what you're actually selling. So we're going to look at a few of the key carriers today that we focus on from the more the IUL perspective today. So when we talk about core carriers, ones that we focus on in the past, Corebridge being one of them, North American, Columbus, Symetra, and National Life Group, they all have different types of illustrations, different types of quirks. So, want to give you a couple little cheat sheet ideas for each of them, so you have an idea, and ultimately, help you progress in your career, your situation to better understand how to run the illustrations and things like that. So, and then also too, I've mentioned it a few times. We are in the process of enhancing the back office per se. So it's not ready yet, but I've shared with you guys a couple times of some of the updates and some of the things that we're working on. So just a quick sneak peek again. It'll look something like this. We'll have everything set up from a back office standpoint, but it's going to be a little bit of a cleaner design. So as you see what we have with 3Mark now as our back office, we'll still be operating with them. They'll still be doing the case management, underwriting support, but we'll have a bit of a cleaner design. So, some of you who are agency managers wanting to see kind of where your agents are at, we'll be able to do that through a drop-down menu here, and you can dial in specifically on your certain people that you're with. Those of you who are trying to reach that next level from a compensation perspective will be able to physically see, where you're at, from a run rate perspective and things like that. Cases that are in-house, these are all fake, just so you know, and stuff like that. So we're going to be continuing to modify and grow this. So just again, a sneak peek of what's to come. And by the way, no platform fees. I wanted to make it specific when creating this that it wasn't going to be an extra charge to the agent because of the fact that you can do it on 3Mark's website. Why would I charge you to do it on mine? So needless to say is I worked very hard to make sure that there were no platform fees. Now if you want to talk about enhancements that we will eventually have, including AI support, that's a different story. But to get your business done and get stuff submitted and placed, this will all be, free from that standpoint. So again, more to come with that. So today, when we talk about submit running illustrations, we're going to talk specifically on dialed in illustrations, not like the term ones that you can do there, but Winflex Web. So we're on the 3Mark portal, the back office, if you will, and we can go to quotes and click on Winflex Web. When we click on Winflex Web, it'll single sign us in to the platform to allow us to run our illustrations. Now, if for some reason I can't run all the illustrations I want to, I'm going to switch to my platform, which has more carriers, just because I've had Winflex for a long time. QOL, North American is not in here. Okay, so my wife doesn't have as many carriers or whatever, so I'm going to go into my version of WinFlex. It's the same thing as if you were single signing in. Just, like I said, I've had this for almost 2 decades, so got a lot of carriers in here. So let's kind of load it up here. And as you can see, like I said, I have a lot of carriers, a lot more carriers. But what we're going to do here is kind of focus for us first off on like an accumulation type sale, which is what a lot of people like talking about. So the first one we'll look at is Corebridge. So you have the protection product and you have the accumulation product. Here is the accumulation product, as you can see. Now, for those who aren't aware, Corebridge does have two sides, or American General has two sides of the fence, and they both look the same, Max Accumulator 3. And then you have Max Accumulator 3, but the three letters in front, QOL, is what distinguish the difference between the two. It does have those living benefits, so chronic critical terminal are inside this QOL platform. So when you run illustrations, if you have a QOL code, which is normally 6 digits, there's no letters in it, then you will be able to get this in your system and you can run the QOL quotes. But if for some reason gave pricing to your customer because all you saw was American General, and even though it says Max Accumulator, there's going to be different pricing. They say free with the QOL. It's not free. It's built-in cost for the living benefits. Doesn't add too much to it, but there is a cost. Now, if you don't see QOL in your instance of Winflex and you have the code, I can help you get it because there is sometimes where, because it's a selective product, it's not in the system. So, what I would need from you is to email me, Phil@valorfs.com, your 6 digit code. And then if you go into your single sign-on for Winflex, go up to your name and click on profile, you'll see a username. It'll be something that will be attached to the single sign-on, your email address, and then you'll see company name. But what I need is this right at the top here. And then I would send that to Corebridge to have it integrated into your system. Okay. So if you do not have it, but you have a 6 digit code, we can get that squared away. So let me pull it back up here, start a new case, QOL, and we'll go to the max accumulator. Now, when you look at the actual designs of an accumulation-based product, when we look right at the first page, you'll see something that kind of stands out. Revised illustration. What does that mean? Why is it there? So if I were to propose to, say, for example's sake, myself, Phil Resch, and I said Phil's preferred plus, Phil's not preferred plus. But I wrote preferred plus, I submitted the application, Phil came back standard on tobacco. Well, for term quotes, you do not need a revised illustration, but if there are any changes between the offer and the acceptance, you need to have a revised illustration and it has to say revised on it. So you could rerun a quote, no problem with the risk class and everything, but if it doesn't have the revised terminology at the bottom of the page, then they will kick it back and say it's not in good order. Okay, so it needs to say revised because it is a change to the original illustration. But I'm going to put my information in here. I'll check revise just so you can see it, but date of birth, and let's just go with standard. So you'll see these table ratings. This would be if you did your field underwriting, so date back to our conversation last week. If you haven't seen it, it is on the YouTube channel, field underwriting. But if, for example's sake, someone was not up to snuff, they had a substandard risk class due to health concerns, diabetes, whatever, then you have these risk classes here. So standard table B is actually 150%. So think of standard as 100%. B, so every letter is going to add 25%. So D is 200%, as you can continue going on, depending on risk class. Temporary flat extras or permanent flat extras could be someone likes to skydive, hang glide, scuba dive deeper than 100 feet or meters. Stuff like that, that can create temporary or permanent flat extras. You survived cancer, and maybe the cancer was about 3 years ago, and you have about 2 more years, so they do a temporary flat extra. $2 per thousand for the next 5 years or whatever it may be. This is where you would put that information. So let's just say I'm run-of-the-mill standard non-tobacco. Solve for, once again, these leave it open for interpretation. You're going to find more and more carriers, if they aren't doing this, will do this. And why is that? Because they don't want to influence how you're going to set up the design. There's tons of fights on social media sites about, oh, properly structured. What's properly structured for an IUL? This or that. There's always fights about how people have messed up on an illustration. I know you're laughing, Michael. There's people who design it improperly or things like that. So the carrier is taking a step back and saying, listen, you're the architect of your own design. Okay, this is your design. You figure out how you want to do it for your customer, and we're leaving it open for you. So you'll see when you talk about an accumulation type design, you'll see that people want to solve for face amount. They generally know the premium and they're trying to figure out the least amount of death benefit. Okay, so I changed it because I know the variable of premium. I don't know what death benefit I want. So I'm going to let the computer work for me. I'm not going to do it. I'm going to let the computer work for me. Um, yes, I can do a temp extra to show you as well too, Netra. I'll do that second, okay? Um, so here, if I did solve with $9,000 premium, this would be like what face amount am I going to get for 9,000 premium with the policy lapsing by age 106. So this cash value at 1,000 will not sustain past age 105. So it's the cheapest or the most face amount for 9,000 in this example. We don't want that. We want to solve for the minimum face, no mech. And you see that thing disappeared because this, if I kept it this way, it would not or should not lapse. But let's say I can do about $500 a month. And I click on the calendar here, and let's say I want to do it for 20 years. Okay. And then off of that, I'm going to click off of that. So if you want to do it by age, so 44 to 63 or 20 years, $500, and then zero. The index strategy, most carriers are wising up now and switching to the S&P because these others are not holding true to what they're supposed to do. Volatility controlled indexes just aren't really doing what they're supposed to, so most carriers are switching to the S&P. We'll get back to disbursements in a second. Policy options, this increasing should match the amount of time, the amount of years I'm funding, because what that'll do is that'll allow me the least amount of death benefit that'll grow with the amount of premium that I'm putting in, and I'm going to change it to monthly. Okay, so here would be 20 years worth of funding. Here would be 20 years worth of increasing, and then we levelize it. Why do we levelize it? Because we want to reduce the cost of insurance. That will allow us to get more cash out of this policy. Now I'm going to click on disbursements and you'll see right here, it is again zeroed out because they don't want to do the design for you. So when does your client want to take income? Let's just say they don't want to take anything until they get to 65 and we'll do to 89. So that's about 25 years, solve for max, and we have income. So if I click calculate here, we'll start this and it'll start illustrating. So give it a sec. Sometimes it takes its sweet time. A lot of times it takes its sweet time. Okay, so 93,255 is the face amount. Once again, it's going to figure it out because you wouldn't be able to figure that out unless you did a lot of hunting and pecking. So we let the software work for us, and you'll see if we go down here to 65, where is it at? Sorry. I'm pulling out 19,000, almost $20,000 a year in income off of a funding mechanism of 6,000 a year. So I'm getting roughly 13,000, almost 13,500 left for 25 years on a $120,000, funding strategy. So you can play around with it a little bit too. Like if I increase this to 150, what it would do is it give me higher living benefits. It would give me a cleaner number, and it would take this 19,338 to like maybe 18,900. So it wouldn't be a big difference, but what it would do is give me more room to put more money into it later if my client chose to do that. So what I typically do is if I'm looking at an income solve, I'll do this one and then, I'll increase it. So I would change it to a no solve and I would put it up to 150 just so people could see a difference. Everything else stayed the same. Okay. All I did was increase the face. Now, some people will say, oh, you're increasing the face so you could get more target. Well, yes, you have more commission from that, but there's a different reason why I do that. Okay, so 6,000 is the most I can put in with that other design. So if, for example's sake, I work somewhere, got a bonus, wanted to put more money into this policy later, I cannot do that because the most I can put in at the face amount of 93,000 is five or $6,000 total. So here, when you think about what you're doing, is you are giving someone more room. So now I can put in 9544 versus 6,000, and I have a higher living benefit amount, and it dropped it by about $1,000. Okay, so I was a little off. But I often show both to the client and say, hey, if you want to really super fund it or juice it, then 93 would make sense. If you want a little space, I call it a little cushion or an opportunity to grow, then we have the opportunity here to do that. So the big thing is that you have different ways that you can illustrate. Once again, I'm the architect of this design. So if someone else came up behind me, like say, I'm gonna pick on Michael because he's here. Michael comes up behind me and does the same illustration, the exact same parameters, but drops from 150 to 120. And now all of a sudden it's like 18,700. He's like, see, I can give you more cash. It's the same product, but I'm the architect, so there's a different way I designed it. So ultimately, you have to explain to your customer what you're doing and why, so they have an understanding of how it's set up. Now, again, this is just a general design. Real quick, because Netra asked, what is the difference between a temporary flat and nothing? So I'm going to do a 45 mil. I'm going to do a $1 million face, just all pay, real quick, level, annual, so you guys can see the difference. So say someone had a temporary flat of say, 350 for 3 years. Okay. And we'll run these two together so we can. And the reason why I'm doing it on the protection product is because once again, you have one situation where you can do the accumulation side. We're solving for the least amount of face amount. Here we have a static face amount, so you can see a pricing difference between the two. And ultimately, will give you an idea what a flat extra can do for the customer or why it's important to understand what it is. Once again, someone can have it for recouping from cancer, different things like that. So you'll see $3.50 is increasing the premium by about $700, between the two. So if I go in and actually check the actual illustration, I like to confirm here, and you'll see 88.58. So actually, I apologize. There are some carriers that will spread that flat over the duration of the contract. So you'll see here, they actually spread it over the duration of the contract. If we did this in the rawest form, let me try and go back and do it from a term perspective. That'll probably show a little bit better. So standard non-tobacco, and I'll just do the 350 flat, right off the bat, 20 year. This should show it, all the way from the get-go, and it'll give you a better idea of, how flats are really designed. So you'll see here 5509. If we go into it, I must be doing something wrong. Oh, shoot. You know what I did? I left the flat on for the entire time. Sorry, guys. Having a blonde moment. No offense to the blondes in the room. The 5508, the 5509 or whatever it was should drop after the third year. So you'll see this. Yep. So $2,000. So you shave off $3,500 because the flat extra is gone. Where do you again see these? Someone has had a heart attack. They apply for insurance, say 3 years after the heart attack. The carrier is not comfortable because they're not out of the woods yet, kind of scenario. So they might put a temporary flat extra on. The worst I've ever seen was $20 per thousand. That was god awful, but it does happen. So you'll see that in some situations. Um, so naturally, does that help?
Yes,
Right. Cool.
thank you.
So yeah, so with permanent products, they can spread it across the entire duration of the contract. So you saw that expense change was not too major. What you can do from a customer perspective is sometimes you can go back and maybe do a reclassification, things like that to help reduce or remove flat extras in case it's a permanent one. So there's different things that we can do. Or again, dating back to last week's conversation, get with our underwriter, see if there's an opportunity to find another carrier who's more favorable, or they'll tell you this is the best offer you're going to get. Tough cookies. Okay. So when you talk about different carriers and different aspects of how they run things, North American is pretty unique as well from how they have their accumulation products set up. So you'll see a three and a four. The three is meant for probably California because they're late to approve anything in the insurance industry. But four, anytime you see a most recent one, go with that. And if you can't for some reason find your state, that it's probably going back to the other one. So Phil Resch, let's see, California is here, so Washington is too. I have no idea why they have that. Um, but we'll go with Tennessee. We'll say standard non-tobacco. So once again, you'll see temporary, permanent flats in case someone needed it. Your revised illustration is right up front. They'll ask for the policy number for the revised illustration there. Solve for, once again, you're the architect of your design. If we're doing an income sale, they do it slightly differently. So they have an income solve. So they are going to quote unquote help with that. And you could do amount of distribution or years of distribution. Um, I don't like using this because I would rather do something along the lines of solve for face amount. And you'll see it's already set up with minimum death benefit, max distributions. So we did $500 a month,
Ahí
a
están. ¿Ya lo lanzaste?
dollar at 120. Index strategy we have, and you'll see they have it set up for 50/50. I don't recommend doing the Fidelity multi-factor yield account for them. So once again, here, do 100% in the S&P account. The multi-factor yield has consistently performed poorly, so I would stay far, far, far away from that. Disbursements, you'll see here, we'll check the box, and they have it set up for you in a different way. So if I want to start at age 65, and I want to end at age 90, then you set it up that way. Policy options, let's say monthly, because that's what I want. Death benefit increasing once again for that 20 years. And then we're going to levelize it after. And then we would hit calculate here. Slowly but surely. And I know it's not because my son's home. He's upstairs playing video games, but you know, these can take a while sometimes. When I would run like when I would run like say 8 carriers at one time, because I'll show you how you can do that too. Um, there's situations where it'll run like 6 of them, and then two I have to hit cancel and then recalculate and stuff like that. So Winflex can get a little funky, but here's the Phil Resch design. So you'll see up, it's going up, and then I'm starting to take income. I stop taking income, and then it goes back up again. Um, and you'll see once you get down to the money page, 6,000, 6.63 rate of return. And, I messed this up, so I screwed this part up. I don't want it to go through to 68 for some reason. I don't know why I have that, but there's your income. See how I messed that up. Solve for, oh yeah, yeah. So 20 would be that. But anyway, you get the idea. So here's their columns. If you're looking for target premiums, they're down here in the bottom right-hand corner. You'll either say the carrier will either say TP or they'll say target. Or would we look at Columbus in just a second? I will show you how they have their setup. Now, the interesting thing about this is if I wanted to do what I did before with the face amounts and changing it up a little bit, I can't do that by just doing no solve because if I did the 150,000 here and I did the $500 a month and I did that for a total of 20 years, now all of a sudden when I come to disbursements, it won't let me, click down and say solve for max. So now I have to hunt and peck inside of this software. It will be less than the 21,000. So now I would have to modify it a little bit with their type of software. So if you go off the guardrails, so to speak, you're going to have to make some adjustments here and go back and forth. There's a method to the madness. Like if it were me and I saw 21,000 for the face amount that I had, I would do like 19,000 for 25 years and see if that works. If it doesn't, go back, shorten it 18.5, and then figure out from there. So there are some nuances with the carriers, and that's kind of what I wanted to share with you today, really, is a lot of these nuances. Um, Now, if I were to, let's say, go with Columbus, okay? So Columbus, I'm not going to lie, is easier to run on their platform, but I'll share with you here a couple things. So for you guys who are are looking for rapid issue, uh, simplified issue, if you will, the Index Explorer now is going to be that. They tout about a 70 to 80% pass-through rate, but they do not have Preferred Plus. So if you have someone who's standard, preferred, then you could try for the now and see if you could get in with non-medical. They go up to 1 million, up to age 60, 59, 60, somewhere around there. And again, the pass-through rates are pretty good for that. If you don't, then you want to do the Explorer Plus. That can go all the way up to Preferred Plus or Preferred Best. But I'll hit Client, click here. Once again, you'll see it's all in different areas. So insured name, we'll say Phil Resch. We'll say Tennessee. We'll say 44. Um, Great question, Natural. What's the most A1C number Columbus takes? Well, I will tell you this. Columbus can take, I've got an 8.0 A1C, a standard non-tobacco because they have a table shave. So table C, B, and A are shaved up to standard. So we got them $1 million IUL at a standard non-tobacco with an 8.0 A1C. Now, I'm actually researching and looking at a few other carriers for something like higher A1C numbers. I've talked with the rep from Foresters, who we haven't talked about yet. They will take vapors and give them non-tobacco, and they will also give. I had a gentleman tell me, I haven't done this myself. He got a 9.6 A1C, 260 pound, 6 foot male, um, a standard non-tobacco with Foresters. So I'm going to look more into the products a little bit, and let you know. They are more around a simplified or non-medical type of product. So when you think that in your head, the easier it is for the customer, potentially more expensive it can also be. Okay, so good with the bad, but if it's something to offer versus nothing at all, so that's a big deal. So we'll circle back on that probably in a few weeks after I do a little bit more research on them. But to kind of answer your question, Netra, about the A1C stuff. So Columbus does the table shave. I've gotten 8.0s. If we're talking higher, that could be a problem, but we can always figure that out. Um, yeah, to illustrate, to kind of talk about Columbus's product, because the question just popped up, illustrate Columbus versus the Value Plus Protector with Core Bridge. That's like bringing a knife to a gunfight. Core Bridge's Value Plus Protector is priced extremely well. Extremely well. When you talk about a GIUL in the industry, there's no one more cost efficient than Corebridge from their standpoint. If you are okay with the life expectancy guarantees, where you'll find Columbus to fit is the accumulation sales. First off, they're probably ranked fourth or fifth range, in the top five if you're spreadsheeting all the carriers. Healthy targets, but they also are very solid for a combo sale. So someone wants income, but they also want death benefit. So a little of both. Not quite the highest death benefit, not quite the least. That's where they'll kind of play very well from that standpoint too. So I don't want to say like, as you look at this product, it's not really designed for competing against the Value Plus. Um, but yeah, so you mean illustrate Columbus product only because they won't get age? Yeah. So yeah, if it, to kind of paraphrase, so from the questioning, if you have someone who has a high A1C like an 8.0, with Corebridge, they're probably not going to take that, or they'll give you like a table eight, like something really bad. On the flip side is Columbus would be more lenient first off with diabetics, and then if you get that table C, then it'll shave it to standard. Once again, up to $1 million, up to age 60, and you can have the table shave. So if it were me here, so Phil Resch, 44, standard tobacco abstainer is non-tobacco. So once again, some of the phraseology that some of these companies use, they have it set up, once again, no solve. So if I wanted to solve for premium, I could do so, face amount, and figure out the premium for 100,000. Or if I want to solve for income with them, they actually stay on the no solve. So here, I want the minimum face, and I want to put in my premium of $500, and I want to click on the calendar and actually do that for 20 years. Okay, so it's a different setup. Even though there it says no solve, you have the minimum there. Disbursements, we would do that here, and we would click on the calendar. So from age 46 to 64, double click, nothing. And 65 to 89, solve for, and then double click here and hit zero again. Policy options, I'm going to change it to monthly. I'm going to change this from years 1 to 20, increasing, and then level after. So they say PAT for monthly. Here, interest rate, it's going to be on the S&P, and I would hit calculate here. So I'm showing you a few of these, kind of in sequence. But what I'll do next is show you if you're spreadsheeting and you want to take a look at these. I recommend first and foremost not spreadsheeting all the carriers in front of the client. Okay. I would say from the back end, make sure that you're doing your due diligence. But if you're talking to the client, have two. Because if you have too many options, they're going to say, I need to look at all these, I need to think about it. Okay. So you want to limit your options, but you want to say that you've looked at XYZ carriers, which I'll show you how to do. Ironic, the face amount is around the same. So if you ever see that you have a face amount that's vastly different than the others, it's probably going to be um, it's probably going to be that you did that one wrong. So I'll click here and we'll go down and we'll see from an income standpoint, you go past all the extra stuff. And so here, they're at 18,860, 685. Now, when Corbridge was at their minimum of the 93, it was about 19,100. So again, we're within shooting distance. Okay. All of them are going to be very similar to each other. Now, I've said this before and I'll say it again. All these illustrations prove is that ink sticks to paper. Okay. So they're at 6.8 rate of return. Corbridge was at 7.02. That 25 or 20 basis points is going to make a difference. So once again, you can't take this for face value. What I would say is base it upon the experience and what the client needs. This is plain vanilla. There's no bells or whistles. Great product, great setup, easy company to work with. And on top of that, all this cash value that continues to grow. You as a financial professional actually do get trails on the cash value too. So as the policy grows, you have more incentive to keep it. It's not a big number, I'm not going to lie, but it is something as well that will stay active as long as the policies are active. So Columbus gives you an incentive to keep your product doing what it's supposed to, and you doing what you're supposed to for your client. I saw you went off mute, Michael. What you got?
I got a question for you.
Yeah.
Based off your experience in the renewal rates, which company do you actually think has a higher likelihood of actually hitting that number?
Well, the reason why I showed the carriers I'm showing is because, from a renewal rate standpoint and an integrity side, Columbus reigns supreme. They have a strong renewal rate. Believe it or not, and you may disagree, but National Life Group also, their in-force block is related to their new business block for the S&P. That's why their cap is at like 8.25 or 9. Okay, so their rate integrity from that standpoint stands true. I inherited some clients for Corbridge for their Max Accum product that was sold in 2018, and that product is still in double digits for their caps for the S&P. It dropped to like 9.25 one time, but then it came back up. So once again, ebbs and flows of the market, what type of options they can purchase, for the betterment of the indexes. But I, from the carriers I've mentioned, from personal experience, from what I've seen and understanding, those are ones that I'm okay with. Now, in regards to someone like an F&G, as you and I both know, they're owned by a company that is a company that looks to boost up numbers and then sell it. BlackRock is very notorious for that. So they're trying to, in my opinion, beef up additional sales, grow the business, and then eventually sell it off to someone else or something else. So you'll see credit rates reduce on someone like an F&G for that very reason. And I hope I'm wrong because I have friends who work there, but just seeing prior, in-force illustrations and things like that, they're notorious. So I don't really often recommend or advise F&G. But if you have someone who is adamant about non-medical, like they will not take a medical, they will not do it at all, F&G is an option, but I still, I'm showing you these quick, 6.8%. If you want a more even conversation, drop the rates to 6%, which you can do with most carriers, and you'll see a better analysis, which in my opinion is a comfortable number to hit, especially if you're designing it more focused around the S&P. So even if some carriers drop their crediting rates to high eights, nines, whatever, you still have buffer because you showed them at a 6% rate of return. Now, some carriers will, or some clients will say, hey, that looks awful. And then some agents will increase the interest rate because they want to win the business. Because someone else came in and said, I can give it to you cheaper and give you better, whatever. So you have to kind of explain why you're doing that, if you are going to do that. Otherwise, someone will hoodwink you. But the other thing too is when you think on the back end, and this is just long term. Again, I want to be with this customer for the next 10, 20, 30 years. I want them to be happy with what I sold them. If you run an in-force illustration, they go by the current illustration rates that they can illustrate. So some carriers in the past would illustrate 7.35%. Now they can only illustrate 6.8%. So what you sold, you can't re-illustrate the way that you anticipated or projected. So if you have a lower expectation, like a 6% rate of return, when the carriers change and the in-force illustrations will also change, you're closer to that number that you're going to hit. So when people say properly structured, reducing the illustrate to around 6% tempers the expectation for the customer, under promise, over deliver, and then also, going with carriers with the S&P, because if I switch to volatility controlled index product, some carriers will have those sing while their S&P looks like a dog with fleas, but expectation is not reality, especially when it goes in force. So that's the big thing. Now, getting close to time, so I want to show you a neat trick that you can do from the multi-carrier perspective to give you an idea. Is We'll start with here. I'm gonna do like I was gonna run multi-carrier for Phil Resch for the LERPs. So if I do max accumulator, like we already showed, okay, Phil Resch, 44, standard non-tobacco, Tennessee resident, all that's the same. I'm gonna do solve for face amount, minimum 500 a month, and I'm gonna do that for 20 years, like we've done already. Should have saved them, so I apologize for redoing this. Index strategy, that's fine. Disbursements, age, I'm gonna do 64, so 65 to 89, and solve for max. Policy options, increasing, 20 years, and then change that to level, and then monthly. I have my setup, okay? So now I want to see multiple carriers at one time. Copy. So I hit the little copy button. I got two. Change product. Let's just go with Columbus. So that's the next one up. Index Explorer Plus. Update client. Now it's telling me I got to fix some things. As you can see, a whole laundry list. There's some things I got to fix. So you can do fix all errors. It'll fix most of them, but this one we'll have to get to in just a second. Okay. Standard tobacco abstainer, so non-tobacco, male 44, that's all correct. Solve for. Once again, you have to fix these things because this is technically broken. This will not come out the way you want it to. So we do no solve, minimum, 20 years. Disbursements, 66 to 90. That'll correlate with what Corebridge has with 65 to 89. I can assure you of that. You'll see policy year one. This is inaccurate. So you want policy year max. That'll fix that error. Otherwise, again, it would come across wrong because it's going to carry some pieces from the prior design that I had to the new one. Policy options, we want 1 to 20 increasing. That's accurate. They don't have monthly in theirs. It's PAT. So here it says PAT. Interest rates, if I ran it now, it's going to be a 0. So as we recall, 6.8 was the number. Now this is clean. This should work. Okay, so when you copy these, you want to make sure that you're fixing the nuances that the carrier has to make sure it's accurate. So builder +4, update client. Again, some issues here that we have to fix. So no table rating, no flat extras, standard. Solve for minimum death benefit, max distribution. So this is accurate. Index, this is a preference. 100 for the S&P. Disbursements, you'll see right here. Now I have to change it. 65, 90. Options, this is accurate. Okay, so everything is done. Now I have 3 carriers that I want to see. And so instead of hitting calculate in orange, I'm going to go over here, select all, and hit calculate on this side, the top left. And we're going to illustrate all 3 at the same time. So it helps you multi-carrier illustrate and save time, as opposed to some people will go to Corebridge's site and run numbers there. Then they want to go and compare with North American, so they go to their site and compare, and then they're like, crap, now I got to adjust this one over here. You can do it all in one spot and make yourself more efficient. Now, as that's running, Netra, to answer your question, to go from increasing to level, that would be a form that you would get on Forms Depot, or you could call and request a form from Corebridge. I'll find that form for you and send it over. But then you could email it back. So inside Corebridge, you can get the Enforce email address and email it back, and they should be able to handle it. Okay, so you'll see here 93, 93, 85. So we go back, and then if you want to put like a cost analysis together or whatever, you can say, hey, Mr. Client, you're getting 19.3 here. Then we go here, and you say, hey, over here, you're getting, it should be 18.6 if we did it right. Oh, 19.9. I got him more money. So I must have messed up the other time. So now Corbridge 19.6, 19.9 from Columbus. And then if we go over here to North American, 21,876. Okay. The one thing I will say is things like this, lower rate of return, but higher income. I often get a little antsy with stuff like that. So to play devil's advocate, why this is looking better. The reason why it's looking better is North American does have a bonus on their loans. So say it's a 5.5% loan. They will credit 1% or so. So it's really 4.5%. But they can change that. Corebridge does that too. Um, so yeah, good point too. A lower cap. So what you see isn't always what you get. Okay. That's why if it were me going between these 3, I would probably pick Columbus. From that standpoint, they have a solid product. Their loan rate can't go higher than 6%. And they have a very high cap right now. So with the living benefits, all 3 of these have living benefits. So long story short, and I apologize for going a little over, but I did also have a longer commercial for the summit. Um, Anyone have any questions about this? Does this make sense?
Yeah, I'm going to add that comment, the 7.55 cap, that's the renewal cap for North American. older generation products. So you notice this is the fourth generation. They keep coming out with new generations and they
Yep.
drop the caps on the prior products. So when you're looking at companies, um, yeah, it shows a great cap in the beginning, but if you're getting a 7.55 cap, it has absolutely no shot at all to reach that 6.63, right? So
Yep.
that's why, like I mentioned, I
Average.
asked Phil, you're right,
Yeah.
like, would you go with Columbus or Corbridge? Because it comes down to cap renewals and what's their integrity with the caps? So
Yep.
North
Yep.
American, not the best when it comes to the S&P cap rate integrity for sure.
Yep. So that's why I say, like, different strokes for different folks. Some people do like North American. They will die by it, live by it, die by it. When you get to the point where I'm at, every carrier is got some perk, bell or whistle. The most important thing that I would say is the one that insures your client at the time of their death is probably the most important one that you'll ever sell them. And from that standpoint, this stuff, we're going to get to a point, and I'm calling it right now, 504 January 22nd of 26. Interest rates are going to come down at some point, and we're going to have to go back to selling life insurance for what it's supposed to be. Death benefit protection, long-term care. So we show income because everyone wants to talk about it, but people seem to forget on the other side of the coin, when you get to retirement, you've accumulated a lot, you're doing great. The worst thing that'll happen is someone will get some form of chronic or critical issue, and next thing you know, your entire nest egg is gone. So don't make your practice solely on accumulation. It's important to know, but don't be a one-trick pony because there are many ways you can serve your client and many ways that should be perceived and viewed. So, you know, all things considered, again, these are ways that you can help speed up the process, but also have you look more professional. Again, having several options for a customer is good for you to analyze. Eventually, you get down to two or three by yourself, but you know, it's good to take a look at and see what people will offer. And in the grand scheme of things, is you always have me to help. If you don't know exactly how to set up the design, go to quotes.valorfs.com, click on income focus, that's your LERP designs, and you can put your name, email address in, client name, date of birth, gender, state of residence, initial premium. So, what's the premium design? When do you want income to come out? Do they have a preferred face amount? Is there any additional money coming in? What type of product do you want to see? IUL, whole life, or both? Do you have additional information like how much are they making? Do you know their social security pension, stuff like that? Any health issues? If you have any in-force illustrations, like something they already have, documentation. But if you want to send me a request to run the quotes for you, I am here to help any way possible. And if you want to specify certain carriers, certain things, you could put that in the health issues or whatever, but it'll come across. But understand that this is the guardrails. So don't, if you still are confused, but you want support and help, I have the income solution kind. I've got the death benefit focus kind. So the questions you need to ask the client are all right here. Okay. So just let me know how I can help. Again, this is set for you, quotes.valorfs.com, and you'll usually get something back within 24 hours at the latest. Okay. All this will be posted on YouTube. It should be there either tonight or tomorrow. So if you guys need anything, holler in the meantime. If you're in the South, get ready for the snow, bundle up. But I will see you guys, those going to the summit next week, Friday, Saturday, Sunday. Looking forward to it. So have a great weekend, and we will talk soon. See you guys.